Good morning. My name is Mary Ellen McGuire, and I'm the Director of the Education Policy Program here at New America. For those of you who are new to New America is a public policy institute dedicated to bringing new voices and new ideas to the fore of the public discourse. Today, the Federal Education Budget Project and Higher Ed Watch welcome all of you to what we expect will be a frank and very lively discussion on the future of the federal student loan program. Specifically, we'll be talking about the Obama administration's recent proposal to stop guaranteeing FFEL loans, make the loans directly, and redirect taxpayer savings into a mandatory Pell Grant program. As everyone in this room knows, this proposal has proved very controversial in the lending community, the higher education community, on Wall Street, and on Capitol Hill. Currently, FFEL providers originate $67 billion worth of loans. Given the money that's at stake, you can imagine the force with which lender lobbyists are proceeding to Capitol Hill, attempting to convince congressional staff that they are in fact solvent, that they are weathering the storm, and that they are more efficient and cheaper than than direct loans. Where does New America stand on this issue? New America is not opposed to a two-pronged competitive student loan program as long as it serves students' best interest. We've spent several years and more than our share of blog space offering ideas for FFEL reform, primarily through the use of an alternative auction mechanism to set the lender subsidy rates. Ultimately, New America's Federal Education Budget Project and Higher Ed Watch contain within their missions the support of fiscally responsible proposals. Fiscal responsibility is the guise under which we'd like to frame today's discussion. Our objective today is to hear from a variety of perspectives, to discuss the pros and cons of the administration's proposal, and to consider an alternative model or two. To that end, we'll be hearing from 4 experts. We'll start today with Robert Shireman, a consultant serving as senior advisor to Education Secretary Arne Duncan. Mr. Shireman will be followed by Scott Fleming, a director with the Chartwell Education Group. Scott will be providing us with a lender perspective today. From there, we'll turn to Paul Comby. Paul Comby is the president and CEO of American Student Assistance, the nation's first student loan guarantor. And finally, we'll close with Jason Delisle, research director of the Education Policy Program here at New America. The format today will be as follows. Each of our presenters will speak for 10 minutes. Then I, as moderator, will take liberty and ask a few questions from the dais. From there, we'll proceed to Q&A from the audience. I will say at the top, if you do not ask a question when you are called upon, I will move on quickly. There is one more thing that I'd like to mention at the top as it relates to our assembled panel. The Education Policy Program in New America did extend an invitation to 4 additional lenders today. All of them politely declined to attend. Thank you very much. Bob, we'll start with you.
Thank you very much, Mary Ellen, and good morning, everyone. Last month, President Obama laid out a bold goal for America to restore our place in the world as the country with the largest proportion of Americans with college degrees. I'll say in developing that bold goal, probably the toughest thing was to figure out whether there was a way to get a president to say the word proportion in a major speech before Congress. But that had to do with the detail we went to avoid things that might cause problems like graduation rates that can cause schools to deny entry to people in order to get rates up. So we approached this very carefully and chose words carefully to make sure that the goal would incentivize the right activities by colleges, by states, and in our federal programs. A major part of that overall goal is making the Pell Grant program an entitlement so that not only our high school seniors, but our children and families in middle school know that especially if they're low income, that there is money there for college when they're ready to apply, and they'll undertake the preparation that they need, the academic preparation that they need in order to go to college. One of the pieces of our higher education plan is a reform of the student loan programs. I'm going to give some overall context for how the administration views the financial aid or the student loan programs, and why we are going in the direction that we have proposed. There are basically three functions in a student loan program. There is getting the capital, the money that is the money for the loans. There is originating the loans, the giving the money to the individual borrower and receiving back from that individual borrower a signed promissory note, them promising to repay that loan. And then the bulk of the actual work on the loans is what people call servicing, which still in Microsoft Word doesn't come up as a verb, but we all apparently use it as one, so I will use it as a verb. The servicing is the answering the phone calls about, did I have a payment due? Am I eligible for a deferment? Sending out the bills, following up when someone doesn't repay, letting people know about their full options for repaying those loans. I'm going to talk about each of these, and let me talk with the third around servicing. The goal in servicing federal student loans, whether they're direct, guaranteed, some other system, there are two main goals that we want to achieve. One is preventing default. In the current FFEL program, if you look at the default rates by lender that have been posted online for years, the most recent ones, fiscal year 06, the default rates are anywhere from 0.2% to 23.3%. Now, there may be good reasons for different lenders having different default rates, but the reality is that we do nothing in the FFEL program to encourage the use of lenders or servicers that seem to do a good job of preventing default. And a major goal of whatever way we design a loan program should be to prevent default. We also have these entities called guarantee agencies, which one of my colleagues at the Department of Education, when I complained of the lack of any analogy to explain to anyone what a guarantee agency is, said it's like a Grateful Dead concert. There's nothing else like it. Dan Madzellen gets credit for that. So I won't try to explain what they are, but in any case, the concept is that they're supposed to help as sort of a backstop on collection. So it's a good concept, but the reality is that the basic approach to the incentives that congressional staff put into the law create incentives that could be seen as too much of an incentive to collect on loans and not enough of an incentive to prevent default on loans. In other words, when somebody can make a lot of money by collecting on a default, they may not have enough of an incentive to prevent that default from happening in the first place. So again, there's not enough of a built-in competitive incentive approach to preventing default. The second area, other than preventing default, is customer satisfaction. The students, borrowers, getting the information that they need when they need it, knowing about their options. In the current direct loan program, customer service survey, independent survey that was done showed that the direct loan servicer, private sector servicer, had done as good or better a job as some of the lenders. Other lenders may not have been part of the survey. Some probably do better, some probably do worse. But the point is here that the way we are moving the direct loan program and the servicing for the FFEL loans purchased by the Department of Education is to have multiple private sector servicers competing based on best service and preventing defaults. So using competition among the private sector entities, they do a good job, they get more business from the federal government collecting on those federal student loans. And if they can't compete, they're not doing a good job, then they get less business. And to the extent that there might be jobs issues here, there need to be just as many people in the private sector servicing student loans, whether it's a FFEL loan, whether it's FFEL, traditional FFEL purchased by the federal government, or direct loan program, the question is, what are the incentives that we build in so that we get the best service that serves taxpayers best and serves borrowers best? That's the approach that we're taking advantage of competition and using the private sector on the servicing side. In terms of origination, we already have an approach for originating Pell Grants at virtually every school in the country. We currently contract with Accenture, which runs a system called the Common Origination and Disbursement System, where schools draw down money from the federal government and then provide data back to the federal government to say, here are the students who received Pell Grants. The concept of adding on an element to that where they draw down money for student loans and send back data that says, here are the students who received federal student loans, is an easy add-on to the system already used for delivering Pell Grants. So, and the major difference is that with a student loan, there is a promissory note that needs to be signed. There is also in FFEL a promissory note that the school needs to make sure gets signed. And the processes certainly are different and involve schools having to learn, if they're in FFEL and they're moving to the direct loan program, they have to learn something different, but it's not something that is enormously complicated. It's also important to point out here that lenders are not making the usual decisions that lenders make. Usually, in a loan program, a lender is deciding, this is a borrower who I want to lend money to because I consider this student to be worthy of an education at this college. Or this is an amount I am willing to borrow because this school is worth it. That's what you would do with someone buying a car, someone buying a home. You would look at the borrower, you would look at the asset, you would make a decision about whether that's a risk you are willing to take as a lender. Lenders do not do that in the federal student loan program. All those decisions are made by the formulas in the federal student loan program or in the federal financial aid program overall, and with the administration of all of that undertaken by financial aid administrators at colleges. This brings me to the issue of the capital that is provided. The lenders are not making the decisions about risk. In fact, we, as the federal government, are protecting them against the default risk. And essentially, when lenders are raising money, they go out to private investors and say, hey, instead of buying a treasury bond, why don't you buy this bond that is backed up by the federal government? So the federal government, on its balance sheet, shows this risk as a contingent liability. In other words, if there's a default on these loans or if interest rates don't turn out as we had anticipated, this is on us. It's on taxpayers. But all of the payments for students, all of the extra interest on top of what is on top of the overall payments the payments go back to the private sector lenders, even though they are not taking the risk on those loans. And we promise these interest subsidies that we have come up with in Congress, commercial paper plus some kind of an increment. And what that means with that kind of a fixed rate that's not based on any kind of competition, it means that if it's enough of a subsidy or too much, the lenders get to keep it. If it's not enough, they don't make the loans and they come back running to us and asking for more. So in the situation when they had 9.5% returns, it was way too much. They took advantage. They brought in more money. It was not anticipated. And they got all that extra money. And then in the last year, when subsidies have not been high enough, they didn't make loans. We had to go to an entirely new system of providing the money up front and paying different kinds of fees. So it's not a competitive system, and it is not a system that assures that the loans actually get made. In the direct loan approach that we are proposing, since we are taking the risk, we provide the funds, borrow the funds from the same people who would lend the money for the bonds that would have gone to lenders in secondary markets in the student loan program. You can think of it over time as we borrow the money, students repay, and in a sense it creates a revolving fund where only the subsidy needs to come from either taxpayers or from borrowing from the capital markets. Because we are receiving the student repayments, that helps to overall cover our costs, and all of this together, these reforms, not only reduce the deficit, but lowers the federal debt over time because it costs us less to subsidize the overall system. We use those savings to plow into the Pell Grant program, to make the Pell Grant program an entitlement so that we don't, so not only do we avoid the potential drop in Pell Grants in a couple of years by $1,000 to $1,200, but we propose an actual increase in Pell Grants that would keep pace with Consumer Price Index plus 1%. We also include $500 million per year to go to states because there is an important argument that comes up around FFEL, and that is that some of the entities that are involved in the Guaranteed Student Loan Program use a portion of their proceeds to do important things with schools and colleges, helping schools and colleges with outreach and information. We think that's a valuable and important valuable and important activity that happens in some states that are lucky enough to have money-making agencies. Other states don't have it. We want all states to have it. And so we've created this fund that can be used for that purpose, as well as to promote improvements in college completion, improving the number of students who actually complete and improving those graduation rates. That's the overview, and I look forward to questions after the additional presentations.
Good morning, everybody. Thanks for coming out. Sounds like this is a fairly popular invitation, and as much as I would like to take credit for that, I'm sure it's actually got a lot more to do with Bob than it does with the rest of us on this panel. I do want to thank our host. Actually, Mary Ellen's one of my favorite people in the entire world, and I've said before I'd walk on broken glass for her. This may be as close as I get to actually doing that. But I do appreciate the opportunity. The policy debate on lending has kind of devolved into what I would characterize as trench warfare. So New America's taken a fairly bold position by getting in between the two camps on this. But I do think it's a dialogue worth having. I think it's important to say that I'm not a student lender. We have worked in the past with student lenders. We don't currently have any contracts with student lenders, but I guess I'm sympathetic enough and the only guy who would say yes, so that makes me qualified to speak on behalf of lenders. But we do agree, at least the lending community does agree with a lot of what the administration has to say. That is, access to college is very important. The FFEL community has been a partner with the federal government in promoting college access for decades, and we feel like we've done a pretty respectable job of doing that. There are literally millions of borrowers who have achieved a college education because they got a loan from a FFEL lender. That's a good thing in our view, and I think the administration would even agree with that the college access on its face is positive. Now, obviously we disagree with some of the methods that the administration is proposing, and before we get too far, I just want to say that it is, I think, important to point out, and Bob did allude to this, that under the current system, we're not actually paying, the government that is not paying a subsidy to lenders. You can look at the subsidy rate on, I'll go through 3 slides here very quickly, but basically on every loan that's been originated since January 1, 2000, the federal government's actually making money. That is, they're collecting a negative subsidy rate from the lenders. If I'm a lender, doesn't matter who I am, if I originate a loan since January 1, 2000, I'm paying back to the federal government. So it's not that I get to keep any excess proceeds. Actually, Congress has repeatedly cut that over time. So that lenders aren't making an excess proceed. We're actually making less on a federal loan than the government will, based on the interest rate environment. So what is it that the government's actually doing? It's not that the government's going to make money to pay for enhancements to the Pell Grant program or any other program that may or may not have a virtue attached to it. That's not the argument that I'm making right now. The issue is that the argument is really the government does a better job of extracting profits from borrowers than the private sector, because the federal government's going to be charging borrowers the same interest rate. And you can see from this chart right here, the red area is the arbitrage rate that the federal government's going to be earning. That is, borrowers are going to pay an identical rate regardless of who the lender is. It's just that the government's going to make more money from that than a private lender would. Well, that by itself doesn't make direct lending or FFEL virtuous or unvirtuous. It just says if the argument is over who does a better job of extracting profits from borrowers, and that happens to be the federal government, well, I'm not sure that that's an appropriate use of federal policy. Just for the sake of illustration, which you probably have already done in your own head, but if I'm an undergraduate borrower and I take out the average amount of debt, $22,700 according to the last College Board study for an undergraduate degree recipient, it doesn't matter who I'm paying the interest rate to, it's going to amount to the same amount over time. A 10-year repayment, I pay about $8,600 in interest if a private lender is holding it or the federal government is holding it. Now, the idea that Bob articulated is that we're going to increase grant aid, and that's going to hopefully reduce the amount that students need to borrow to pay for a college education. And that is, I think, a great plan in theory. Over time, however, you can see that the federal government has considerably increased grant aid to the tune of almost 80%, adjusted for inflation over the last 10 years, and that hasn't had any significant reduction in terms of borrowing. Students are still borrowing, and that's been up about 70% over the last 10 years. So there's not a one-to-one correlation saying that for every dollar that I increase in grant aid, that's a reduction in the amount of tuition that a borrower has to pay. Partly because not every borrower, not every student qualifies for the Pell Grant. Only about 50% of undergraduate students actually get a Pell Grant, of those who apply. Graduate students obviously don't get a Pell Grant at all. So in some ways you're saying to graduate students in particular, please pay an arbitrage rate that's extraordinarily high, because the government does have a cheaper cost of capital, to subsidize undergraduate students, but only half of undergraduate students that actually qualify for a Pell Grant. That doesn't seem to be a fair distribution of the benefit. Now, I'll just dive in. I guess the ultimate fighting championship is not the fastest growing spectator sport because there are two guys being very nice to each other in a cage. It's because they throw them in there and they just beat the lights out of each other. And that's kind of what this debate has turned into. And I'm not going to try and take that tone, because I actually do believe that the administration is approaching this from a sincere belief that they want to do the right thing. And lenders, for the most part, don't disagree with what the administration is trying to accomplish. It's simply that we disagree with the practice. So, with that said, direct lending, a switch to 100% direct lending, is effectively a tax. You're taking a set of borrowers, you're applying the same interest rate regardless of who they borrow from. It's just that the federal government is going to charge an interest rate of 6.8% and extract all of the profit for its own purposes. Now, the definition of a tax is, as you can see from dictionary.com, is just simply a sum of money demanded by a government. In this case, the government is demanding rate, 6.8% rate of return on a loan that it's making. Now, instead of taxing an asset, what the government is doing in this case is actually taxing aspirations, because you're telling students that are borrowing that the more that you borrow, the more the government is going to make, the more that the government is going to put back into the Pell Grant program. That seems to be somewhat backwards in terms of the approach to federal student financial aid policy. It's not that there's anything wrong with a Pell Grant, but it's paying for it by taxing borrowers that have need in the first place. Now, the irony in the 100% direct lending program, or the proposal, I think, is that it does put the government in the same position that lenders have been criticized for before. You're saying to a lender, if you are earning excess interest and you're turning that into borrower benefits in the form of interest rate reductions, or suppose it's a benefit for on-time repayment, those are obviously proof that the lender is making too much money, that the lender is taking advantage of the student or advantage of the federal government because you have more money than you need, because you have excess capital to provide benefits like that. In this case, the federal government must be doing the same thing because they're extracting profits from the borrower and they're applying it to a scholarship program in the form of Pell Grants. But in this case, it's somehow virtuous. Well, simply because the government is doing it and not a private lender doesn't seem to make the case that it's virtuous or not virtuous. It simply is what it is. If it were a private lender doing it, it would be criticized, but in the case of the federal government, it's not. And that seems to be a bit of a paradox. Now, stepping back from the trench warfare for a second, if I can, the government is going to provide $1.4 to $1.8 trillion in student financial aid over the next 10 years. That's an enormous amount of money. The $100 billion for Pell is not an insignificant amount, but it's still, by all accounts, it's not going to tip the scales. College is not going to be any more or less affordable, even with a substantial amount of money dedicated to the Pell Grant program. The real issue is that the cost of college is out of control. Lenders are not setting tuition prices. The government is not setting tuition prices. Both are in a position to do much better if tuition goes up. If the government's making the loans and they extract all the profits, if the private lenders are making the loans, then we too can benefit. But the issue isn't that the tuition is going down. It's quite the opposite. So we're going to spend an enormous amount of money to finance a college education. And it doesn't seem like the government is getting a true value from the investment that it's making because the cost continues to rise. Now, if you were to eliminate FFEL, you do actually have a net negative effect. One of the first things that goes is the philanthropic activities. You don't see college access programs being supported. You don't see the financial aid nights, those types of things. There's scholarships and debt forgiveness programs, interest rate reductions. All of that disappears. In some cases, making the loans more expensive for borrowers, but in many cases, making the process much more difficult for borrowers to understand. You can argue, and I think many will, that the government can take over those responsibilities. But that doesn't come free. It's not without a cost. The government, if it's going to replace those activities, it has to pay for it somehow. Also, you're eliminating choice. The borrower has no... When I attended school and I borrowed from the neighborhood community credit union, where my parents had banked for 30 years, that was a choice that I was able to make. Under a 100% direct lending scenario, that's not an option any longer. Maybe that's a good thing or not a good thing, but in my view, and I think the view of many, it is a good thing to have consumer choice among lenders. You also have no one to protect the borrower interest. And this is one area I think where we agree to the extent that the private or the administration has admitted and I think concedes the point that private servicing is done better, that the private sector actually can facilitate servicing of student loans more effectively than the federal government can. They currently contract to it. The proposal is to expand the number of contractors so that the private sector handles all the servicing for loans regardless of who makes those. And so I think that's what we would say, is that the private sector does do a better job of servicing. But you don't need to eliminate the FFEL program to achieve that level of servicing. Now, I think I would go out on a limb and say if you wanted to impose certain limits on default rates or things like that, there are certainly policy arguments to be made on how you can improve the level of service even within the FFEL program. But I don't think you get there just by eliminating it altogether. Finally, and this isn't on the slide, but I think there is a case to be made that if you go to 100% direct lending, all of the innovation that is currently present in the FFEL program disappears. The federal budget, by its very nature, is resistant or perhaps impervious to innovation. You can't do anything to benefit borrowers by sliding down an interest rate here or there because there's a cost to the federal government. Even if a borrower wants to take a 2% reduction, which many borrowers in the FFEL program do claim, 2% reduction on interest rate payments because they've made 4 consecutive years of on-time payments, if the government wanted to do a similar thing, there's a cost impact. So the government can't offer you the same benefit. There's still substantial controversy over what shall actually means when it comes to the direct lending program. That if the government wants to be more responsive to borrowers, in some cases it has to play very fast and loose with what federal law says. Now, that just says that the federal government and the federal budget and Congress too have a hard time being as nimble as the private market. And just as a quick aside, Bob mentioned the interest rate setting, and I think that's true. That for many years, 9.5% rate was a floor. Then it became a ceiling, and more than anything else, I think it simply says that Congress has a very hard time setting market interest rates. They can't react quickly enough to market conditions to tell the lenders what the interest rate should be. So that leads me into my next point, is that can you move beyond FFEL versus DL? And I think you can. I think we're actually at a point where we should. The first thing that I would do is stop putting Congress in the position of having to set a federal rate or a rate for student lenders. Let the market set a rate. You can do that by any number of different mechanisms, but you could use a federal index rate that's already out there. You could use home mortgage rates, for example. and peg the borrower interest rate to that. Let the direct lending program make rates at that level, and if the private lenders can beat that rate, then they can compete directly against the federal government and make the loan. Doing this, you eliminate the need for any special allowance payment on the part of the lender, which is, over time, the only part of the FFEL program that actually costs the government money, unless you include the in-school subsidy payment, which I haven't heard anybody argue that we're trying to do away, except maybe the College Board. I think they suggested moving it to the back end. But I think we agree with the administration. You can use the common origination and disbursement system to originate private loans as well as federal direct loans. That there's no inherent limitation on the capacity to do that. You can provide credit enhancements for the borrower at no additional cost to the government, because if the government defaults on if a borrower defaults on a loan that's guaranteed by the government makes that money back in collections. That's always been the assumption in the federal budget, so you can do so without any cost. And by doing that, by eliminating special allowance payments and by eliminating several of the other costs associated with the existing FFEL program, you generate savings that could still be applied to support Pell or any other borrower benefit that you need. The advantage of doing this, in addition to the cost savings, is that you do also preserve consumer interest, that you have competition among lenders, you have incentives for strong servicing, you have the individual attentiveness to borrowers that the FFEL program can provide, you do have private participation, and you improve the overall program effectiveness. Now, that said, there is a lot that I think we agree with the administration on, and I want to highlight that it's not about a blind allegiance to any particular vein of thought. It's that we agree there's an important issue in this country right now, and that is college access, and I think the private lenders in FFEL are committed to improving college access overall. We simply disagree with the methodology that the administration has put forward. Thanks.
Good morning. I guess my role is none of the above from a process point of view. If we look at the last 15 years in student loans and student lending, there has been this ongoing debate between FFEL versus DL and the debate really has focused on, and I'm going to loosely go through the presentation, by the way, just to save time. It has been loosely based on which program costs less. It's been a budget question. It's been a budget battle. Been a lot of ancillary arguments, but the fundamental issue we've been talking about is which program costs less from the federal government's point of view. And in many respects, we need to start looking at the program as how effective have those two programs been, and I'm saying together how effective they've been. There's been a lot of competition between the two programs, and when DL was implemented back in the early 90s, it was actually solving a problem. And the problem was I was a director of financial aid on a campus and had to deal with multiple lenders, multiple guarantors, multiple systems, multiple forms, and so on from that point of view. And it was a problem. It was an issue that had not been solved, and DL focused on solving it. And DL is an efficient program from that point of view. It's a single system, it is single delivery mechanism, single processes, single procedures, and so on. So it solved that problem. But in implementing that, it actually created a competition between the FFEL program. And the FFEL program started creating those types of efficiencies and developing the systems in common line and so on. And that competition grew in the late 90s into 2000. It actually started with price competition, and we would not have had the student loan rates drop as they've had without that effective competition between the two programs. So the simple point is, if we are having to choose between, we're in this box and we're choosing between one or the other, no matter which way we go, we're going to lose something from this process. And the fact of the matter is, what we should be looking at is how to actually take that competition and implement it and put it in from a policy point of view so it's effectively working to go forward. So we are continuing to improve the systems through competition from the program. We are continuing to compete on price, and we are most effectively continuing to compete on service to borrowers. Bob lined up the program that we have three issues we've got to deal with. The capital, the source of capital, how to deal with the capital and bring it forward, the origination process, and so on, and then everything that happens after that. loan servicing, debt management, and so on from that point of view. And I think that's the appropriate way of looking at it. And the simple point is there are ways of bringing multiple sources of capital into this program. Scott outlined one, where you can effectively have that competition going on, so there is a price competition in that point of view. Efficiency through the system is the single system, and DL has shown it, a single origination system. It's a federal financial aid program. I firmly believe it should be managed, that origination process should be managed by the federal government, but allowing for both private and public capital to play on that. Because the two programs have been running, basically trying to kneecap each other over the last 17 years, the programs were built independent of each other. So you have, if a campus chooses DL, they choose the DL system, which by definition precludes private capital. And if you choose a FFEL system, the FFEL program, you exclude the federal government as a lender from that point of view. And at the same point in time, certain FFEL systems can exclude other FFEL lenders from that point of view. So the system actually can become a means of restricting competition within a thing. So there needs to be a single system, and that DL answer is I think, the appropriate thing. My interest is actually on the last part of this, and because if we look at the problem that DL solved in the early 90s, we need to look at what problems do we need to solve today. And today the problem is debt, all right? And it's not only student debt. I mean, from a national point of view, we don't have a credit crisis. We have a debt crisis from that perspective. And you can't pick up the newspaper on any given day without seeing some story about how student debt has affected the borrowers after they've graduated. So if we look at it from a policy point of view, we've got to remember that we've chosen debt. As a nation, we've chosen debt as the primary means of financing access to education. We've given the students a Hobbesian choice. You can go to the college of a choice and get in debt or not go. And so from that perspective, the fact that we are using debt is one of the key elements that we have to look at in solving the problems that we have to do. So my basic comment is we need to step back. It's not this either FFELP or DL choice, that we need to look at ways that we're making sure we're solving today's problems as we go forward, and that problem is student debt. So if we're looking at it, and we really wanted to, last summer I was invited to speak in China and asked to describe the U.S. program, and they're looking to develop their own loan program. There's no way I could have recommended that they would come up with what we came up with today from that point of view. So if we're looking at how we're going to go forward, we need to choose the principles that were going to guide us. And it's not just the cheapest program. And one of the things I like, if we can do health care and we can do it cheap, but cheap is not preventative. You don't get in health care, and you don't use preventive medicine, preventative things are the first thing to go when you're talking about efficiency in budgets from that point of view. So if we're going to do it, we need to focus on the right thing. And the right thing is going to be on the consumer. Because we tend to think of the borrower as a recipient, an applicant first, and then a recipient, we forget that once they sign that promissory note, they do become consumers. And whether it's between the federal government or a private lender, they are a consumer, they have rights. But the interesting thing is, because we are inflicting this debt on them for access purposes, for policy, to better their lives, and if we better their lives, we get better taxes, we have a better nation, and it's educated force. Because we're doing that, they are actually consumers with extra rights. And we've got to think of this factor that if we are getting them into debt, the federal government has an obligation to help them get out of debt in this process. And so the key element, and Bob has focused on it, there is how do we effectively provide those debt management services in the program. So we can have alternative sources of capital. We can look at a single system that opens up the program to competition and choice for the borrower. But we need to also focus on how we efficiently providing debt management. So the key point is if we look at what is debt management, we need to think about it from the point of view of the federal programs. We've had a long dialogue in this country about financial literacy, the use of financial literacy, and so on, how we do that. We need to start thinking of these federal programs as not only the main financial aid program, access to education, but over the life of the loan, these programs become the ultimate teachable moment for those students in learning how to manage credit. And we need to start focusing on that fact that it's not just waiting for the borrower to get into trouble, that debt management is not due diligence, that you're sending a letter when they're 30 days past due or 45 days past due. It's not waiting for them to get in trouble. It's actually being there in a proactive way, providing them the information they need before they get into trouble so they can make reasonable, good consumer decisions in that process. Congress has supplied to the students in this program all kinds of remedies to solve problems. But communicating those remedies is very difficult to the borrower unless you can proactively communicate with them. So debt management really is looking at the federal student loans as that teachable moment, and it's a continuum of intervention. You need to be it needs to be providing education activities in a proactive way, targeted and engaging to the borrower before they get into trouble, so that it impacts their financial wellness. This is proactive. It's something that is not measured by profitability. It can't be said you can do these 5 things and that's debt management. It's due diligence process. You need to be able to be out there and effectively competing to do this from that perspective and moving forward. Bob has mentioned that you know the guarantor community, and ASA is the oldest guarantor in the country. We were created in 1956. That nobody can describe what they do. ASA effectively back in the mid-90s, we looked at this. We looked at the role of the guarantor and basically came up to the same conclusion. My joke with my board of directors at the time was a New York Times cartoon that showed a man standing in front of the boardroom saying, the good news is we can lower costs by eliminating the middleman. The bad news is we're the middleman. So the point is, when we looked at this back in the 90s and looked at is there a role in origination process? And as I said, effectively, you can create a more streamlined origination process and eliminate the guarantor's functionality there. Federal government does guarantee the loans right now, so that whole concept of insuring the loans went down when the higher HEAF went down in the late 80s. And even from a collection point of view, that's something that the private sector would be happy to do from that point of view. And as a public purpose entity, we needed to focus on what is our role as a not-for-profit, as a public purpose entity. And as a public purpose entity, we should be doing something that the government should do, but can't do effectively from a perspective, and that the private sector can't do. And the one thing that the guarantors, that this public purpose can do is the debt management side of it. It is a public purpose initiative that provides the services to the borrower over the life of the loan that they need in a proactive way. So one of the points is ASA got the voluntary flexible agreement arrangement. The voluntary flexible agreement gives the Secretary of Education the ability to waive rules and regulations, to look at new ways of financing guarantors. ASA entered into a VFA in 2001, and what we basically said is our mission now was to help students successfully complete a program of education financing and repayment. Not access to education, but complete that program of financing and repayment. So we created the VFA, basically changed the financing structure so we're only paid for loans in good standing, and set up a series of programs above and beyond the standard due diligence process. And each one of these programs is aimed at a targeted population at a targeted time to give them the information they need at that time. So the Journeys is basically aimed at getting the first payment in the door. And so it's an effective program looking at getting that first payment in and maintaining those payments over the cohort default period. Transitions is for withdrawing students. There's a consolidation program. So each one of these is aimed at that teachable moment for the borrowers from that point of view. At ASA, we look at it from the point of view that debt management is a contact sport. You need to be reaching out and contacting the borrower, and that means not just making a telephone call or leaving a message. It means actually getting into a dialogue with the borrower from that point of view. And all data shows that once you enter into that dialogue, you have this contact with the borrower, it's effective. So this is ASA's cohort default rate, the green line, versus the national cohort default rate. And I'm not sure if you can see it, but from 2000, all right, ASA, we were a Massachusetts guarantor. We had a fairly good portfolio. And so in 2000, we were below the national average. We can see once we started the VFA, the spread just kept getting bigger and bigger and bigger from that point of view. So that contact, that communication has been effective from a national point of view. This is the cohort rate. The other rate that measures guarantors is called the trigger rate. The trigger rate measures of all the loans that are in repayment, of all loans that can default, what percentage does default. Again, in 2001, ASA was 61% of the national average. And we were able to drop that rate from 61 to 60 to 54%, all the way down to 49% in 2004. At that point in time, ASA became more of a national guarantor. Our portfolio grew from about $4 billion to over $45 billion in national volume from that perspective. So you can see we went back up to 58% because the risk of the portfolio went up. up to 59, and then started getting control of it again, and back down to 59. We never got up to the point. So we have what is effectively a national portfolio now that looks like it all came from Massachusetts. So contact works. And so the simple point on debt management from that point of view is you need to be able to arrange these programs in such a way that there is multiple sources of capital, so there's competition from price point of view. There is the efficient single system that does it, and there is competition on this type of service that effectively provides the borrower with that, and it can only be done not from a contractual point of view, it can only be done from a public purpose point of view with those entities competing with each other from that. The final point, this is actually just a model between the financing and, whoops, I can't do that. Sorry. Basically, I'm sorry that went through that. That just slide showed how we moved the money from the back end where guarantors are paid for collections to the front end where we're paid for loans, only loans in good standing. Stop, sir. So, old model, only 33% of the revenue came from origination and managing the portfolio, and over 62% came from collections. Now, this is ASA's data, by the way, meaning we had a low default rate to begin with, so the numbers are not too high. And under the new model, you can move as much as 70% of all revenue to managing loans in good standing. So if you're only paid for loans in good standing, if they go 90 days past due, you stop getting paid. So all the incentive is to keep the borrower in good standing or get them back into good standing from that perspective. Thank you.
I'm Jason Delisle, here with New America Foundation. And because I'm going last, I will try and keep it brief so we can get to questions. I'm sure a lot of you are dying to ask questions. What I want to do quickly is just sort of give you my perspective as a conservative and a Republican on some of the absurdities I see in the debate on federal student loan programs. And we'll start with one that I think is a little bit difficult. I opened up the Roll Call newspaper, I think it was this week or maybe last week, and I saw an ad criticizing the Obama administration's proposal to go to 100% direct lending and eliminate the guaranteed loan program. The criticism was that this would increase the national debt. It sort of turns the argument on its head that we're trying to move towards a lower cost program, and here now someone has told you moving to the lower cost program will increase the national debt. The argument that they're trying to make here is that because direct loans, the federal government is lending directly, it has to borrow to make the loan. So in that sense, when it issues a $2,000 loan, the federal government borrows $2,000 from somebody else to make the loan. And in that regard, yes, the national debt is going up. But when a lender makes a loan on behalf of the federal government's on the hook for that loan for 97% of the principal of the loan. So essentially, the risks and obligations to the taxpayer of both of those loans are nearly identical. And to suggest that somehow we haven't increased the national debt when the bank makes the loan that the taxpayer is on the hook for is just, it's totally absurd. To take it one step further, what you could then argue if you followed that line of reasoning that this ad suggested in Roll Call, we could eliminate all of the national debt tomorrow if we had banks issue treasury bonds for the federal government. And we just kept them on their books. We backed them all 100%. And it's just gone. It's just there. I mean, the federal government is still on the hook for all of it. But it's not on our books anymore. And that's essentially what this argument is in saying direct loans increase the debt and the FFEL program doesn't. It just doesn't make any sense. Again, it's important to remember in this argument that according to OMB and CBO and a lot of other budget experts, the direct loan program is cheaper and therefore has less of an impact on the national debt. So that's one argument. Another one you'll hear that is sort of strange, that strikes me as particularly strange, especially as a conservative, is that the FFEL program is more efficient because it relies on private entities, relies on the private market. And direct loans doesn't, because it's a direct loan, the federal government's making the loan, and so doesn't have any of the efficiencies that go along with the private market. I'm sort of receptive to this because I think generally that's the case when you involve private market. It is more efficient. But because the student loan programs are so strange and designed in such a bizarre way, especially the FFEL program, the guaranteed loan program, the efficiency of the private market is never really brought to bear. The subsidies that are set and paid to lenders are set by Congress. There's no competition in the private market for those subsidies. So we don't say to lenders, compete on the subsidy, and then we'll take a low bidder and we'll find out, how much efficiency is really there. We don't do that. Congress just makes up a subsidy. Bob was talking about it, and so was Scott, where we have we basically pick an index and then we add a little bit more to it. Right now it's 1.79 percentage points. Why 1.79? I don't know. It's really just made up. It's members of Congress sitting around saying, what do you think, 1.8, 1.9, 1.4, and then the student loan lobbyists come in and say, no, it's got to be 1.65, 1.62, and we settle on a number. Now, to the extent that lenders are really efficient, this is the private market efficiency argument coming in, to the extent that the lenders are very efficient in making the loans, they still collect the same subsidy. So all of the benefits of efficiency accrue to themselves through higher profit margins, which is not necessarily a bad thing. We want companies to be profitable. But to turn around and make the argument that this efficiency somehow benefits the federal government or taxpayers under the FFEL program is totally absurd. And the irony of the efficiency argument of involving private lenders, I would say, is that it actually might be less efficient. I mean, if you think about it, you think of the draw on the private sector. So lenders making loans in the FFEL program are actually carrying out a government program. So this is really government activity done by a private company. But we've enlisted literally thousands of lenders to do this. Sales forces, thousands of people in sales forces that go out to try and make these loans, which, by the way, the terms of the loans are set by the federal government already. So there's very, very little room to sort of differentiate the product. But still, we have thousands of people making them, sales forces, the money spent on advertising, which again this is essentially government activity that private lenders have taken on. Guarantee agencies, software programs that lenders come up with. And now think, when you have that kind of complexity, now as a Republican, what immediately I think of, if you have that kind of complexity in a government program, imagine the oversight that you need to make sure no one is doing anything incorrectly or doing anything improper, which we know has happened several times in this program. And in fact, it's this complexity that makes the program sort of scandal-prone. 9.5% bond scandal, we had the pay-for-play scandal, and who knows what other ones may be lurking out there that we just haven't discovered yet because the program is so complicated. So that, I think, is sort of the private market efficiencies debate of this program. And I'll run through just a couple more really quickly. Scott was talking about the borrower benefits. You hear this a lot in this debate. That lenders, again, the loans are the terms of the loan for the borrower are set in statute. So the interest rate is fixed at 6.8% for the borrower. The length of repayment is 10 to 20 years or longer if you have a lot of debt. And so all that's set in law. And what people are talking about, and what Scott's talking about when we say that the lenders provide borrower benefits, is that they provide a little bit more, a little bit better terms than what's set in law. But what lenders are doing is they're saying, well, you know what, the subsidy I'm getting from the federal government is generous enough that I can pass a little bit more of that on to the student in form of better benefits. So the most common one is that a few years ago was that borrowers would give students or lenders would give students a 1 percentage point interest rate reduction for on-time repayment. That was the most common one. But you don't need to preserve high subsidies for lenders in the hopes that they'll pass these benefits on to borrowers. Remember, all the terms in the loan are set in statute. So Congress, if the borrower benefits are so important to members of Congress, and you'll hear them on the Senate floor and on the House floor saying we need to preserve the borrower benefits, they can write them into law. If they want a 5.8% interest rate for all students, they can write that into law and all students will get it. Now, Scott said that when the direct loan program provides extra borrower benefits, it costs something. And when the guaranteed loan program provides these borrower benefits through lenders, it doesn't cost anything. Well, it does cost something. It's the lender laying off a little bit extra of the subsidy it gets from the federal government to create a more generous student loan. So the money's all coming from the same source. It's coming from the taxpayer through a subsidy. So, the borrower benefits of the direct loan program and the guaranteed loan program can provide the exact same terms for borrowers and the same level of generous benefits. It's just Congress just needs to write it into law like they do for the base set of benefits. But I've found that most of the members of Congress who are arguing we need to preserve high lender subsidies in the hopes that maybe they'll pass that along to a student, none of them are offering any legislation to actually write the borrower benefits into law. They'd rather pass it through a lender and hope they'll give it to the student, which I think is not the best way to go if you really want students to have better terms on their loans. And the last point I want to make is the argument about customer service. This comes up a lot between these two loan programs in this debate. People say that, and again, as a conservative and a Republican, the argument that people say is that, well, the direct loan program is run by the federal government, so it's got inferior public service, and the guaranteed loan program is run by private lenders, and it has superior customer service. I'm a little bit receptive to that, but, private lenders do have a little bit different incentive to provide really good customer service in that they are competing for the student's business for the loan, and they may be competing for further business for different products. So if you have a loan from Citibank, your student loan, and it's the only loan, the only product you have from Citibank, and you call them and they never answer the phone, when you want a mortgage or or insurance, you may not go with Citibank because you've been so upset with the customer service you've gotten. So there is a little bit of disciplining that goes on that may not go on with a government-run servicer. But it's not quite so black and white because in the direct loan program, the federal government contracts with private servicers. So again, they don't have the same competitive discipline that I just described in the Citibank example, but they are competing for the business for the contract from the federal government. And it's, in fact, maybe some of the same private servicers running both loan programs. But let's just assume for a minute that the FFEL community and the guaranteed loan program, their supporters are right. There's much better customer service in that program than the direct loan program for both students and for financial aid offices. But what's that worth? How much? How much more should we pay for it, right? Better customer service costs you more. Is it worth $1 billion more each year? 5? I mean, we don't really know, and no one talks about it in those terms. And I think it's really important to ask that because that's the trade-off. If that's what the supporters of the FFEL program really believe, then they have to also ask, how much is it worth and how much more are we paying for it? I really doubt that it's worth $94 billion over 10 years. I mean, that's quite a large trade-off to be making for slightly better customer service. And I'm using CBO's cost estimates that just came out a few weeks ago over 10 years, the extra cost for the guaranteed loan program. Now, I've just run you through a few of these arguments. There are many more. And if you'd like help in understanding them or like to hear maybe a different perspective, you can always tune to our Higher Ed Watch blog where we spend a lot of time trying to help people understand these arguments. Thank you.
Thank you. I'm just going to try to keep this short because I'm sure there's a lot of questions from the audience. One of the things that I want to address, sort of building off of Jason, is the arguments that we've heard. And another argument that I saw recently featured in an advertisement was that moving towards the administration's proposal is a mistake because you'll be nationalizing the student loan program. And my response to this, and I'm interested what your comments would be on this from our panelists here, is how do you nationalize a program that is already federally run? The FFEL program provides a subsidy to banks. It guarantees against risk. And now the program actually provides lenders with capital, which is exactly what they were designed to do. So I'm just interested in what your thoughts are on this argument that you'd be nationalizing the federal student loan program. Bob, do you want to start?
Sure. I think we've kind of asked the same question when we've heard the argument. We're not in a situation of it's a government-run program versus a private sector-run program. They're both some of each. Certainly, the impression has been created over the last 15 years that the direct loan program is a government program. So maybe the way we should actually handle this is to let people think that and say, okay, we'll do something in between. Let's use private sector servicers in the direct loan program instead of having all these government employees collect on the loans. So we'll go the middle route. We'll hire private sector servicers and use competition in the direct loan. And we can even call it something different. And we're splitting the difference. We'll use private sector servicers and give up on our big government program that hasn't existed.
Scott?
Yeah, I figured I'd have to respond to that.
We're hoping you will.
The issue, I guess, and if I'm going to be brutally honest, I don't think the nationalization argument works that well for the lenders, just because it has been using government capital. The true nationalization, and Bob alluded to this, would be if the government were to take over every aspect of the lending programs, administer it themselves, service it themselves, hire 10,000 new federal government employees to handle the servicing and not go through federal contracting. So, yeah, you do actually end up pushing about 2,000, Jason made this point, you push out 2,000 private lenders by going to 100% direct lending. It's not true nationalization, but there is an impact there. You are actually putting a lot of people out of business if you were to go to 100% direct lending. Maybe not all of them want to stay in the lending business, but there are a lot that do. And by moving to 100% direct lending, you are ending business for a lot of people who are currently involved. So, yeah, it's not a true nationalization, but there are impacts, and I don't think we can talk lightly about those when who knows what's going to happen in terms of the private servicing contracts. There may be companies out there that employ a few hundred people in the student loan industry. They're probably not going to win a servicing contract, but they aren't going to be making loans anymore. So that's something, those 200 people are going to have to find something else to do. Whether you agree that they should be making loans and whether the government should be subsidizing those loans, or in the current context, not subsidizing those loans since the government's not paying a subsidy right now, that's still an issue that you're going to have to deal with, is what happens to those 200 people. You know, are they going to move on to something else? Are they going to become government contract employees, or are they going to find another job somewhere? But it's not the same as nationalization, but I don't think you can completely escape that argument.
Well, I think the point you made that this is a federal program. I think we've lost track of that somewhere along the lines, that it is financial aid. This is a financial aid program. It's there for a purpose. It's providing access to higher education. Along the line, along the way, these arguments, because we're in the box between FFEL and DL, we have all these arguments that go on, but they are within the construct of that. Those are the only two vote sets you can have, and those are the only two decision points you can make. And at some point in time, the arguments start sounding like the old beer commercial: "Tastes great, less filling." You know, who cares? So I go back. The simple point is, if we are looking at, and this is, I think, the key point, nationalization, federalization, I don't care. If we focus on what we need to do right now, and I think the point is we have a rare opportunity. We have a rare opportunity. We have a president who's willing to make change, who's looking at these changes. We have the programs are obviously at a point where the FFEL is not working, period, from that perspective. So if we are going to do that, do we stay in the box and just keep that? We have, this one failed, so therefore we're here. And without looking at what are the things wrong with that program as well, in a constructive way. And the only way we can look at it is, how does it help the borrower? So I don't think the the borrower, in some sense, has been asked, who do they want to borrow from this point of view? What does the consumer want in this process? And we don't have that question. I've seen some numbers that, if given the choice, borrowers would pick a local private lender. So the point is, how do you bring those people into that program so they have that type of choice? So I think that's the point. You can deal with all these issues of the budget and so on, but it still misses the point. What's good for the borrower, what works effectively for them, not only from the point of view of access and origination and getting the money, but over the life of the loan in managing that debt that we are giving them as part of our financial aid programs.
Well, I think the nationalization argument is kind of silly, but again, it tries to play on this sort of deception that the FFEL program, the guaranteed loan program, is some sort of private lending. It's private loans or private market activity, but it's government activity. I mean, the government, these lenders are making the loans because it's a government program. I mean, that's really what it is. And so, from a conservative point of view, if 1,000 lenders go out of business who are running a government program, but everyone still gets the loan at the end of the day, all the students still get the loan, well, that's good. We've gained efficiency. We have fewer people running a program that delivers the same benefits to everyone. And yeah, those people have lost their jobs, but maybe they will find jobs that are perhaps more productive, more necessary, or generate a higher return for themselves and for taxpayers and for the economy as a whole. But if this is an argument about jobs and we want the program to preserve jobs and create jobs, well, then triple the subsidy to lenders. Quadruple it. They'll get more money and they'll hire more people. We'll have more sales forces. We'll have more advertising, and we'll create more jobs. Now, I don't know if that's really the best use of our resources, but if you do want to create more jobs, that's how you could do it through the program.
Thank you. My next question I'm actually going to direct to Bob, and certainly if anyone wants to comment on it or Bob's response, please do. Bob, as you know, the direct loan program has been plagued by criticisms about poor quality of service for some time now. And there is, and I do think it's a valid concern in the community about the capacity of the department to assume all future loans. So my question to you is, what plans does the administration have to ensure a smooth transition to 100% direct lending if that, in fact, comes to fruition?
Well, the department has been preparing for 100% federal loans even before this administration. The previous administration began, and part of this is because of the ECASLA, the emergency program that was set up to keep the FFEL origination occurring. Many of those loans, perhaps most of those loans, will be purchased by the federal government, and the federal government will be contracting with private sector servicers to collect on those loans. And so whether it is FFEL loans purchased by the federal government or direct loans made by the federal government, we are preparing to have full servicing capacity for all of those loans. So that will not depend on having that capacity. Doesn't depend on whether Congress acts or not, because the lenders have the right to sell all of their loans to us. So we have to be prepared with the private sector servicers who can handle that full capacity. That's part of the reason for the contract that is currently in its selection phase to select some servicers, multiple servicers. And the other benefit of having those multiple servicers is we can promote the competition to make sure that we get high quality service, prevent defaults, and get borrowers the information that they need.
Would anyone like to comment? All right, I'll throw it to the audience. Christina is here with a microphone. If you could just raise your hand, I'll direct her your way. Up front.
Thank you. Alma Clayton Pedersen, Association of American Colleges and Universities. Bob, you underscored a number of times the notion of an entitlement. Can you say a little bit more about the effect on student motivation and aspiration and our global economic sustainability?
Sure, thank you. Yes, well, we have proposed making the Pell Grant an entitlement because it's been, every time we run into these situations where there is a shortfall in the program, there are articles around the country that make it sound like you may or may not get a Pell Grant, or there may not be an increase in the Pell Grant. And even though on a year-by-year basis, whatever Congress has set the Pell Grant maximum at, everybody who qualifies gets their Pell Grant the way it is run right now, it does not have that firm feeling of a promise from the federal government. And the population that we can make the most progress with, if we're going to reach this national goal of completing degrees, the population we can make the most progress with are low-income students and low-income families. And so making a firm commitment from the federal government that the Pell Grant's not just going to be there this coming fall, but it's going to be there the fall after that, and after that, and after that, and after that, so that we can tell somebody who's we can give somebody an estimate who's in middle school right now and say, well, if you were going to college today, here's how much you would get, and this program is locked in. And so it's going to be there when you graduate from high school. Not only makes them think, I can pay for college, it makes them think, yes, I should take these courses. Yes, I should really try an algebra because there's money for me for college. College is not out of the question. That's the kind of feeling we want to promote in K through 12 to help prepare for and get us to that college completion goal.
Thank you. Actually, it's there, and then we'll come over back front.
Hi, Doug Letterman from Inside Higher Ed. I guess this is mostly directed at Bob. I guess as somebody who's covered this on and off for a long time, I've long considered the fighting between the two programs to be distracting, if not destructive. And I guess I'm curious if there's been a lot of talk recently about a third way. I mean, several of you referred to it in some ways. And I guess I'm asking Bob, is there a third way that would sort of fully take advantage of the strengths of the existing two programs and avoid the weaknesses of the existing two programs? I mean, obviously, you've sort of hinted that you think your way is a third way a little bit, but I guess have you seen any programs or any proposals or and you think the administration is truly open to a proposal that would take it truly in a third way?
I've seen some talk of other ways without enough detail to know what it really means, but there are probably other ways of achieving the same kinds of goals. So if we can figure out how we can get capital at a reasonable rate, have a origination system that works well for schools, and has the right incentives at the back end to pay for servicing. And really, I think a lot of what we're talking about, 90% plus of what we're really talking about here, is how do you arrange for and pay for servicing on loans? And do you do it at the back end? Do you have a front end thing where somehow entities are selected by some school or some student or something? It's really, it's not a question of who gets loans, who doesn't get loans. It's all a question of how do you arrange for and pay for servicing of the loans, because that's where the real work is. And there are probably other ways of doing it, and when there are detailed enough proposals to get the kind of analysis from Congress and Congressional Budget Office to know what it means going forward in the legislative process, then that's worth looking at.
Maybe I just want to add one thing to that. I think that if there is some sort of consensus building or moving towards a third way, and it involves private lenders, I think it's really important that the compensation mechanism and the incentive system for lenders to participate, or even servicers, whatever you want to call them, have some sort of market pricing mechanism in them, so that we don't get in this business, we get away from this business in a new loan program of Congress arbitrarily setting subsidy rates, sort of not really knowing what it's trying to do and making up these rates. And so I think the best way for reform would be to create some sort of pricing mechanism. Now, there's an auction out there that is may be tried this year, maybe next year. It's on the books, though, in the Plus Loan program, where lenders have to put in bids for how low they'd be willing to go to offer the loans as they exist today, and this is met with incredible opposition from the lending community. So I really, just in my experience with that aspect of student loan reform, I would be surprised if consensus emerged from the lending community around anything that a third way that would have them competing for the subsidies they earn from the federal government. But again, I think that would be one of the most important components of that, any of those proposals.
It's interesting to note, once you ask the right question, you start getting commonality, from people. There's common ground here. Then it's not this FFEL versus DL. One of the points that I think needs to be brought forward, that if there is going to be a means of getting to a third way, and I think you're right, it's going to be very difficult to get the lenders and the guarantors, for that matter, into some kind of agreement as to what it should be, public, not-for-profit lenders, private sector lenders, and so on. It's going to be very difficult. It will take leadership. And I think that's the point where it is the opportunity for the administration to take that leadership role and actually open up the dialogue. So if we close off the dialogue because the administration has its proposal, then we're not going to have the conversation. And the only way we can have the conversation is that the administration take the leadership position and actually take the same strength of position you're taking now in trying to identify those positive third ways. You have a backstop already, so it's why not have the dialogue?
Okay, another question?
Hi, Shelley Saunders, American Student Assistance. Just to follow up on that point, is there a reason why we're rushing through budget reconciliation as opposed to having a more open forum for the third way?
I would say this is an open forum. It's not determined whether budget reconciliation will happen or not. That's up to Congress. But it seems to me there's a lot of good conversation going on and people putting together proposals that they've been working on for a number of months. Just one other thing, the CASLA only goes until for this next coming year. A decision has to be made whether there's reconciliation or not.
This question's for Bob. I'm sorry, Michael Dannenberg with New America Foundation. This question is for Bob. Correct me if I'm wrong, but I think part of the administration's proposal is that students would get to choose amongst their servicers that would be awarded a contract. If that's wrong, please let me know. If it's correct, that choice, I'm guessing, has a cost. Australia, for example, collects its student loan system through their internal revenue service. We could do the same. I'm wondering what the cost is for not doing that. So what's the cost of the choice that Jason referred to? And was there opposition to having the IRS collect student loan payments because of ideological reasons, because you thought there would be superior borrower service, or because the savings weren't worth it?
On your first point, I'm not aware of a student choosing servicers component, though that could be part of the discussions on the contract. I just don't know on the current contracts that are being discussed. IRS collection of student loan payments is not something that we spent time looking into. There definitely are complications if we were to go in that kind of a direction. Not the least of which is you'd want to be careful about unpaid student loan payments not being treated as an unpaid tax liability, which has some pretty severe consequences. Now, those are kinds of things that one could potentially deal with, but it's not something that we looked into.
In the back.
Hi, yes, Angie Anderson from the State University of New York. I actually have a question for Jason. Is that correct? You mentioned choice was something that students had in the FFEL program, and I'm confused because I think that a student chooses a school not based on what they are provided. So do you have any examples or statistical evidence of a student choosing a school solely based on the fact that they would have a FFEL loan and be able to choose their lender versus going to a DL school where they don't get to choose?
Well, no, you bring up a good point, though, when you ask for sort of statistics and evidence. And I have yet to find a really good, rigorous study about showing how students feel about the customer service they're getting between different lenders and also the direct loan program that wasn't funded by lenders. So I don't know of anything that addresses that issue. But as far as students choosing schools for a particular loan program, I don't think that happens at all. And then when they get to school, I don't think they spend a lot of time trying to figure out which lender to borrow from. They get a list of lenders that there's one at the top. List isn't usually in alphabetical order. And they pick the lender at the top. Or there may be some sort of like negative feedback where there's 3 lenders on this list that the financial aid office has prepared for the student, and they've heard something really, really bad about one of them from other students at the school, maybe. And so they don't pick that one, they pick one of the other 2. So I really think that's about all that goes into choosing. Now, lenders can always sell your loan too, so there's no guarantee that you're going to have that lender forever. And you know, if you don't like the customer service the lender is giving you, you can't move your loan to another lender. So, you know, so these ideas of choice and customer service are pretty muddled. I hope, does that answer your question? Or?
Actually, I meant Scott.
Yeah.
All right. Well, what did I do? Do you have anything to add, Scott?
Mr. Fleming.
No, I was going to respond anyway. So I think, you know, I maybe the only thing I agree with Jason on is that borrowers probably don't choose schools based on lenders. I think that's probably a given. But I do think that the American economy is based on a certain amount of consumer choice. Now, you may not know anything about the lenders that you're given on that list. Maybe you don't want to. Maybe you just want to take the one at the top. But I think historically, Americans like to be able to say, even if I don't want to do the homework and choose the lender, I'd still like to be given the choice. You know, we don't go to McDonald's and say, I'll have the breakfast. We go and say, I'd like the number 1 because I like the eggs or whatever. So I think there is an inherent value that's hard to measure, an intrinsic value included in choice, that there is a benefit to that. Now, as far as there being a choice in servicer, you know, Mr. Dannenberg, Michael, who I got your attention, I see. You know, you may include a choice among servicers, but you know, I see that as being a very difficult thing for students because on the front end, at least you may know the lender. Like in my case, I knew the lender. I wanted to borrow from the credit union. Many students may not want to do that, but in terms of servicers, you're trying to decide on somebody maybe 4 or 5 years down the road who's going to service that loan based on what information. That they competed successfully in a government contract because they could do it more cost effectively than the next guy. And I don't know that that's necessarily the same thing as preserving consumer choice.
It's interesting that if you bring up that concept of the school and the relationship to the borrower's choice, I think it's an important element that we have to bring into this. The school's the trusted agent in this process. When the student selects, they do select a school. They're not selecting a school because the school has a lender. They're selecting a school for the education, and they're going there. And as such, they really do have a lot of authority. A number of years ago, Mike reminds me, we were in the debates about school as lender program. Inherent problem with school as lender program was there was a conflict of interest there if the school was the lender, and you think of student choice from that perspective. So one of the things as we go forward that we have to think about, if we think about the consumer, and very often the freshmen don't know, but you know who they want to lend, especially if their local bank can't do it. You know, and basically because of the nature of this program, we've gotten fewer and fewer lenders in the program because of the high entry costs, the money in the systems, and so on, which is one of the arguments, frankly, for a single federal system, that the borrower should be able to come with their local community bank's application and get it processed as efficiently as any other application. And they should be able to choose that bank, a guarantor, their local guarantor if they want, regardless of the school. But the school is always going to have an authoritative role there. So we have to think about that concept of a neutral third party. There can't be conflicts there. They have to be in a position to be able to make some decisions on behalf of the bar, provide a list of lenders and or guarantors or service providers who they believe have been providing good service, and they have the data to show that from over time. That neutrality thing also goes from a debt management point of view, and I'm a firm believer that the only way you can really provide effective debt management is you never have any asset interest in the loan itself, that you can't be associated with that loan. You have to have a distance because you have to be able to advise the borrower, regardless of whether it's profitable to the lender. It's in the borrower's interests. And in that sense, there has to be someone who is that advocate for the borrower, who gives the borrower a voice throughout this process. And the key thing is, no matter how you work it, because in the end, even if there is some form of private capital involved, in the end, the federal government isn't even involved in that transaction. That's, in some sense, the federal government is not a neutral party on this transaction. That's one of the things we have to think about, that it can't be a government service provider who's providing the contract, because some things may not be cost effective for the government that may be effective for the borrower to do. And so this concept of neutrality, I think, is very important as we go forward. So if you're thinking about the consumer and their rights and their choice, you need that effective third party, both from a campus point of view and from a debt management point of view. And those are the two bodies, if you really worked it out, that will be consistent over the life of the loan with the borrower. It's going to be the school, and it's going to be that debt management person. And if you ask the schools, and we've asked them at ASA, who's responsible for debt management, the schools will say they are. They firmly believe it, that it's their alum you're talking about. They believe it. They don't have the ability to carry out the work effectively, though. They just don't have the staff to deal with the last 20 classes as well as the incoming class. So it is this matter of there is a strong sense of responsibility from the schools in managing this process. And we've shown data within ASA that the most effective way of dealing with the bar and communicating with them is actually through the school.
Okay. We actually had two gentlemen up here. Oh, there's Christina. I had one here and one here.
And please address people by their last name. So.
Right, and then we'll go over there.
It was a good answer.
Good morning. Good morning, Cedric Lawson with U.S. Student Association. Correct me if I'm wrong, but I heard no one opposed competitive bidding for the FFEL program. And if anyone would like to elaborate, if they feel that competitive bidding is a good option to continue with on the road to making this all better.
Well, from the lender perspective, a lot of the competitive bidding proposals run into a lot of operational challenges, and you can see with the PLUS loan auction that New America in particular has been very fond of. The operational challenges have been so significant that even Congress agreed you couldn't go forward with implementation right now. Part of the problem is that lenders in the private sector make capital or originate capital based on their cost of producing that. That is, they have to come up with the money to make the loan. That changes over time. So you can't go in on a date certain and say, this is how much I bid for this, for the origination rights on a particular loan product, because my cost of capital may change. It may change 3 weeks from now, it may change 6 months from now, it may change 2 years from now, but under the PLUS loan auction, I actually have to commit to make those loans at a certain rate over a certain period of time. And if I don't, my participation in the Title IV program could be limited, suspended, or terminated. Those are pretty unfavorable conditions for a lender to feel like I want to compete, and that's why you don't have any lenders coming forward to say, this is a great idea. Now, there is a similar proposal that I think could be very effective in getting lenders involved in more competitive arrangement, and that has nothing to do with Congress setting the rates. That would be with simply telling the private sector that this is the rate on a federal direct student loan, period. If you can beat that rate, compete against the federal government to take the borrowers from the federal government and do it. And if you were to do that, and the private sector can compete, and currently I think they could, then certainly with the credit enhancement of a guarantee, then the government could get out of the business of making special allowance payments. You do set a market rate. The borrower does get an interest rate that's based on the market cost of capital, and you do it all without the government having to incur any additional costs. To me, that sounds like maybe it's too much of a silver bullet, but it seems like a pretty rational response. And you avoid the problem that I think just about everybody at the table agrees with, is that Congress does a pretty poor job of setting interest rates.
We use competitive bidding in order to price the capital for the direct loan program. They're called treasury auctions, highly efficient. That's why our cost of borrowing is relatively low and the interest paid by borrowers exceeds what our current borrowing rates are. It also means that when interest rates go up, the cost to us of the low interest rates that students will be paying at that point is less, because we're not having to pay lenders their cost of borrowing, which is higher than ours. So we use competitive bidding. It works well. Everyone has no problem in making sure that everyone gets the direct loan that they're eligible for. We also use competitive bidding on the servicing side, taking into account the quality of service that can be provided as well as cost to taxpayers. The competitive bidding on the PLUS auction attempts to take the providing capital and providing servicing long term and put it all into one auction, which isn't actually a good way of doing it. So we split it up into get the capital, provide for the servicing, rather than, and it goes back to my point about this is all about how do you arrange for and pay for servicing. And if you try to do it all as one thing, you end up with all of these problems. If you chunk it out with the different pieces, which is get the capital, provide for origination, arrange for servicing, then it's doable and it works.
My concern with auctions, and again it goes back to the consumer, they're hostile to consumer choice. Basically, the consumer's chattel in an auction. The loan is put out to a bid for at a certain price. There's no competition in it from the borrower's perspective, and the borrower gets the results of the auction. It's maybe an effective program for the federal government lowering costs, but it's not an effective consumer program. And that's really the key point. There must be ways where we can market price capital and still provide the consumer with some choice in that process.
We all have to remember that the way the PLUS loan auction was designed, it was designed more politically than around the perfect policy solution, since we had to make sure that the auctions were run at the state level and not regionally, because certain senators wanted to make sure certain lenders could lend in those states, and so all of these things start to crop up when you're tinkering with an existing system. But I would like to add one important point, and Scott kind of alluded to it, that that lenders have said they're not going to bid to make PLUS loans in this auction, and that's a big weak part of the program. But that same problem exists in the FFEL program as it's currently designed. A reporter asked me, what happens, why might an auction fail? I said, well, no lenders show up. And they say, oh, wow, that's terrible. I'm like, yeah, but the FFEL program could fail too if no lenders show up. It's the exact same risk. And we actually almost saw that happen with the credit market problems. And Congress stepped in and created these eCASLA programs where they said, you can sell the loan back to the federal government, and we'll even sort of in a roundabout way give you federal capital to make the loans. So that's what's largely kept them in the program. Without eCASLA, it's possible that the FFEL program would have experienced pretty serious disruptions in the same way that the auction could have failed.
Hi, my name is Neil Snyder. I'm with the American Speech Language Hearing Association, and since the subject of the event is student loans generally, I wanted to ask, I guess, Bob, about the Perkins loan changes, and if any of you have comments. And also, Congress has dictated that in certain situations, people can get their loans canceled for certain things, and I'm wondering how any of you feel about how those fall out in any of these changes.
Sure, thank you. We have proposed a dramatic expansion of the Perkins program. Our feeling is that colleges need some flexible money that they can provide to students for whom the regular Stafford loan limits are not enough, and that we can't micromanage from the federal level what those circumstances might be. And so the concept at the local level of schools having a pot of money they can apply to those special situation is a good concept. In order to accomplish that, we basically, instead of having little revolving funds at colleges that we put money into, which was just from a budgetary standpoint, I won't get into the details, but was difficult to grow that approach. A lot of schools don't want to manage a local revolving fund, and there are other reasons as well. So we instead make it part of the overall federal student loan program. Instead of about $1 billion in loans, it'd be about $6 billion. So a lot more flexible money for colleges. There are, in terms of the terms of the loan would be 5%. There would not be an in-school interest subsidy as there is now. So some trade-off there for wanting to have much more money, not quite as good benefits on the loans. They would gain access to the public service loan forgiveness that exists now in the direct loan program, as well as income-based repayment that's available, and those are good back-end protections that help to make sure that people can go into public service, even though they may have a substantial amount of federal student loans.
One of the only issues you look at with the Perkins loan is, again, going back to debt management, is by definition you're instituting multiple payment streams for the borrower. So if you go back to the consumer, they have 2 minimum payments they have to make the loans. So it is, again, it's a debt management issue. We have to factor in, if we're going to give them multiple loans, then we have to make sure that the information is there for them to be able to manage those multiple payments and the stream of payments at the later time. The other point on the back-end benefits I think is really important is the College Board made a proposal of eliminating the subsidies up front on these loans for the borrower, and actually placing the subsidies on the back end, which may actually be a more efficient way of targeting those subsidies over the life of the loan. And in that way, you can actually almost separate. One of the problems we have actually is when we talk about special allowance payments, commingled in there is borrower benefits. And if you can separate those two things out, you actually have a clear view of what the cost of the program is to the federal government, because the benefits to the borrowers are one thing and the cost of capital is another, and you could actually separate those by going with this back-end benefit. And basically what you've created is you have a delivery vehicle, the loan, for benefits that you may or may not want to provide to borrowers over the life of the loan. It may be an effective way of dealing with it, so to expand those types of life of the loan benefits.
I want to be respectful of my panelists' time, so last question, if it's a quick one. There's a woman back there. Keep your hand up so she can find you.
Reba Raffaelli with Career College Association. I'm just curious that you had one revenue estimate from the administration for going to direct lending, and CBO has a much higher limit revenue raiser impact. Why the difference in what's in your calculations versus they didn't put into their calculations?
I haven't looked at it in enormous detail. My general understanding, and don't take this as the Bible on exactly this, is that economic assumptions are different. So I think the easiest example to give is that if you assume, as CBO does, that the economy does not recover, as well as OMB assumes the economy recovers, then people continue to be very eager to loan money to the federal government, but not the private sector. So the amount we have to pay in commercial paper plus an increment in FFEL is going to be high. The amount that the government and that gap between the government's cost of borrowing and private costs. That's one way that economic assumptions can have an impact on the difference between the costs of the two programs.
Just one word on that. I think the lending community would tar and feather me if I didn't mention this at some point. So I think that's actually a pretty spectacular example of why federal budget forecasts tend to be wrong. And this isn't a slight against CBO or OMB. It's just that anytime you try and prognosticate the future, it turns out to be a very difficult challenge. You have to make certain assumptions. Any one of those assumptions could be wrong, and that's why over time neither program has scored exactly what it was anticipated to score over time. Direct lending has a little bit worse of a track record, and that it's tended to cost a lot more than people think. FFEL tends to go the other way, that it costs a lot less. Currently, the federal government's making money on FFEL, when a year ago or 2 years ago that wasn't the case. And so you could see in the FY09 budget, the subsidy cost estimate for a direct loan was actually higher for the first time maybe ever in the OMB budget than it was for a FFEL loan. It didn't take long for that to change because the interest rate environment changed subsequently to the publication of the FY09 budget. But you just see the turbulence in interest rates, inflation rates, and any number of assumptions that go into these budget forecasts can change. And every time they do, that makes the future analysis, the future prognostication incorrect. So the bottom line, I guess, is that today CBO may say that a shift to 100% direct lending means that we'll save $94 billion. 3 months' time, that could change completely. And there's no way to know. And I don't think any of us up here, if we could predict the future, we'd be in different jobs. But if we can't predict the future, we have to go on the best of analyses, and those analyses change over time, then we're always going to run into the scoring problems created by the federal budget process.
Okay, well, I'd like to thank our panelists today, our guests, and encourage all of you to read higheredwatch.org.